An expert now. He's Derek Burleton, Deputy Chief Economist at Toronto Dominion Bank. Thank you for coming in. What do you think?
My pleasure.
What do you think?
You know, nothing earth-shattering. I think we've seen downside surprises in recent months. Before that, there was a string of upside surprises. It seems like this one more or less in line with expectations. My guess is, given the headline of core kind of fell very much in line with expectations. You mentioned 0.3. That is a little hotter on a month-to-month basis. It's probably a soft 0.3, probably a 0.25 that rounds up. Very focused right now on shorter-term trends. The 3-month changes in CPI, my guess is they're still pointing in the right direction on core. Headline, of course, is moving the other way, but I think most of us feel that that's a short-term, temporary move in the wrong direction. But, you know, you mentioned it in the setup that core is what matters to the Fed. I'm not downplaying the impact of headline on consumer sentiment, on what consumers are facing in terms of some of the headwinds. But next week with the Fed, the core is what matters. And I don't think this is really going to move the needle all that much. I think there's probably still enough there for the Fed to stand pat.
Okay, we should take a look at some reaction because I'm seeing on Bloomberg that both yields and the futures contracts are moving. I'm seeing that the S&P 500 futures contracts are down on this news, not down by a huge amount, but down, yeah, well, there you see it graphically. You can see that drop. So there's, I guess, a sense of disappointment in the equity markets that we didn't get a softer than expected reading on inflation, and yields are moving up on the 2-year and the 10-year by about 5 basis points. I'm going to try and get those 3-month trend lines, but this is at least a third consecutive month of subdued core inflation, correct?
Yeah, and I think the markets have been hoping to see a 0.2, so don't get me wrong. I mean, that's a bit of a disappointment. My sense is that the recent trends are still more favorable. I think, you know, we're still a distance from that 2% target on core that the Fed is trying to pull off. And, you know, so I'm certainly not popping any champagne corks yet. I'm still looking at demand in the US economy that's quite strong. I mean, third quarter GDP is blowing through the roof, and most forecasts of a slowdown are simply just that right now. They're forecasts. We're not really seeing it show up in the hard data. So really am somewhat concerned we may in the coming months see more of a backup, certainly persistence. But, yeah, I mean, yeah, the markets were looking at a little bit better number. But for the most part, I think this pretty much tells the story as expected.
Well, and so what do you expect from the Fed in, I guess, the meetings that are most in play, the November meeting and December meeting?
Yeah, that's still a very close call. You know, pull out a coin. I think it's a coin flip right now. We don't have any further hikes in our forecast. But, you know, certainly tough talk. We're going to hear a lot of tough talk next week. Still concerned about inflation, the fact the economy is still running too fast. That'll buy them a bit of time. But I think for the Fed to remain on hold, we're going to have to see core continue to step down in the next month's data. And, you know, we're going to have to see the job market continue to gradually lose air. I do think the soft landing outcome is still very much feasible. Mm-hmm. I know we have not seen it a lot in the past when rates have moved to this degree. Lots of differences in the current cycle, things like ESG investment, all the massive subsidies for semiconductors, a lot of impetus in the economy that's offsetting it. But, yeah, so, you know, it's very data dependent. And, you know, if we see a number like this, 0.25, 0.2 in the next month, I do think the November they'll probably still stand pat. Okay,
here are some headlines from Bloomberg. Gasoline contributed more than half of the gain in headline inflation in August, as I think people expected. The Bureau of Labor Statistics, which issues this number, cites rent, motor vehicle insurance, medical care, and personal care is pushing up core inflation. Real average hourly earnings rose by 0.5%. I'm hearing what is being characterized as a disappointment, and I think Derek has alluded to it, is that on a monthly basis, the market didn't get the 0.2% advance in core inflation that it was expecting and hoping for. That number came in at 0.3%, and that's why we're seeing a bit of an uptick in yields and a decline in the futures market. So that is what you need to know on the U.S. inflation numbers. What is your view here in Canada, at the Bank of Canada, given the lower inflation readings we have in this country?
Yeah, it's a similar story. We don't have any further Bank of Canada rate hikes. A bit of a different picture in Canada where we do have a highly leveraged consumer. We are seeing some evidence of consumer caution play out in the latest data. And so I think that the worries around further rate hikes are a little bit less in Canada than in the U.S. And prospect for rate cuts, I think, next year. I think one could make the case that we probably would see the Canada move a little bit earlier than the Fed in cutting rates, albeit that's, at least 6 months down the road still. Canadian inflation, similar story in that, we've seen good progress. There's still a gap to 2%. But again, softer signs in the activity data, consumer spending, and the job market. We've seen the unemployment rate pop up a bit more on a trend basis than in the U.S. So, but I don't see a dramatic different picture. I do worry about the Canadian dollar going forward. I do think that as we move deeper into the fall, the divergence in the economies it's going to be more of a clear concern of markets, and I do see further widening in some of these rate expectations going forward.
We speak to portfolio managers, and we spoke to one today who see the Canadian consumer in pretty blunt terms. They say with higher rates, Canadian consumers are going to have to spend more on servicing their mortgages, and that inevitably means less on particularly consumer discretionary goods. Do you see it the same way?
Yes, I do. Certainly when I look to 2024, the mortgage renewal shock intensifies. I do think one thing you can throw into the equation, a few things that help the consumer in Canada. Government transfers are still providing a big lift to incomes. We saw in the second quarter data just recently, 10% gain in personal disposable income, and government transfers were a big part of that. The federal GST rebate for food, some of the other subsidies really propped up income. That story, I think, will continue. I do see the federal government and provincial governments to some extent helping out with some of these pressures. Excess savings are still pretty notable in Canada. Savings rate jumped up. So it's not all doom and gloom for the consumer. And I do think when it comes to the rate story, I mean, this has been so well telegraphed. I do think why we're not seeing it play out a little bit more than some had feared was that it's been, households have been able to plan for it to some extent. And some have been able to renew their mortgage early and the like. So, we don't have a severe recession in Canada in part because of some of these offsetting dynamics.
Derek, thank you.